Let's do another case study in investor relations. This time it's Oracle's fiscal second quarter 2026 earnings call. And let's set the stage here. This is about the backlog versus CapEx paradox. And the company beat on adjusted EPS, had a great backlog, but missed on revenue. The key issue in the quarter was that the company increased expectations on CapEx spend for the year from $25 billion to $50 billion. That's a huge change in expectations. And the irony of the quarter, why the stock went down, is that there was a lack of data on AI customers and growth or justifying this massive change in CapEx expectations. So let's get into this idea of CapEx versus cash flow. And when you think about it, when a company has a 100% increase in CapEx, you're expecting to see a similar significant yield in free cash flow. And you're not necessarily seeing that in the numbers today at Oracle, and we don't know if you will in the future quarters. Consider in 2023, $1 of CapEx generated a stable return in its high margin database business. Whereas in fiscal second quarter 26, that same dollar of CapEx was generating negative free cash flow. This is concerning. So let's get into what we see as the three key issues of the quarter. And this has been an issue in communications infrastructure for years, going back 10, 15 years. And it starts with structural concentration risk. You're focused on a couple of core customers in the AI space, and that's a problem. Number two, you have credit quality. Investors are starting to wonder, can OpenAI and these other AI customers actually deliver on these commitments that they have with Oracle and others? And third, it's the data deficit. And to me, this is the crux of the whole quarter and the whole issue, that Oracle didn't do enough in terms of clear metrics and data to justify the growth at OpenAI and in AI in general to close the gap as to why they had to significantly change CapEx guidance. So let's get into a quick scale of spend comparison to illustrate what I'm talking about. And if you look at the fiscal year 26 revenue guide, Microsoft is about 4.4x larger than Oracle. And for the fiscal year 26 CapEx guide, Microsoft's almost 2 times as large as Oracle. But what gets really interesting is when you look at CapEx as a percent of revenue, Microsoft's only 32%, Oracle is 75%. And it's this 75% versus the 32 that illustrates all of these problems of the structural concentration, the credit quality, and the data deficit in the print at Oracle. So let's get into what are the key learnings. CapEx matters even at high growth companies. Second, an amazing backlog is not going to offset a dramatic increase in your CapEx spend expectations for the year. And most importantly, the way you fill the gap and drive credibility is through clear metrics and data that illustrates why the CapEx growth is justified. If you don't do that, investors aren't going to believe you, and you're going to have problems in future quarters. Thanks for watching.